For the last 5 to 10 years, every promoter, sponsor, every inexperienced, incompetent real estate promoter pitched all of their investors on IRR. And when that terminal event did not occur, what they had was a disaster. The disaster was inability to refinance. What they had was a disaster in making cash flow and distributions. And now they have a problem that the asset's not worth what they paid for it. Why is it the investment world insists on pushing the words or the acronym IRR? What does that mean? Why do they focus on internal rate of return? Let me tell you why. This is like the old shell game. What I want to do is I want to convince you what you should be thinking about is not my due diligence, not my reputation, not my success and failure. What I want you to do is be completely enamored by the sugar in that cookie. I want you to be completely enamored by the size of the fireworks I throw up in the air and I light. What I want you to do is look at the acronym IRR, and my IRR is better than everybody else. It's almost like show and tell. Really, in my view, as somebody who's been involved in investments since 1985, internal rate of return is really a measurement based on a critical element to that investment. I got to have a terminal point. I got to have a point by which I exit. You know what I found? I found some of the most successful, wealthy investors that I've ever managed in 41 years. They don't ever look to sell. They don't want to sell that piece of real estate. They don't want to sell that building. They don't want to sell that mineral right. They don't want to sell that working area. They don't want to sell that mobile home park. Now, don't get me wrong. They do sell, and they will sell, but it's not based on IRR. You know what it's usually based on? A better place to deploy the capital from the asset they own, which allows them to continue to grow their net worth, grow their cash flow, and increase the viability of their entire portfolio. But most of my wealthiest investors, they don't like the word IRR. They don't like the acronym IRR. What it means to them is your investment, your strategy, your financial model will fail if I don't get out of it within a certain time frame. Today, the real estate market is choking on IRR. For the last 5 to 10 years, every promoter, sponsor, every inexperienced, incompetent real estate promoter pitched all of their investors on IRR. And when that terminal event did not occur, what they had was a disaster. The disaster was inability to refinance. What they had was a disaster in making cash flow and distributions. And now they have a problem that the asset's not worth what they paid for it. So the IRR was kind of a death sentence. But every investor that I've seen that invested in those IRR-driven assets, they became enamored by IRR like a big star in the sky, and they forgot to look at the fundamental facts. I'm going to challenge you as a sophisticated investor, a new investor, an old or young investor. Let's do this. Let's stop talking about IRR. And every time somebody mentions IRR, you should look at that as an eject button and get the hell out.